2 years ago, I made my first ever investment in the stock market. I put €100 into an S&P 500 ETF, and every 15 minutes I checked to see if it had gone up in value. Since then, my portfolio has naturally grown in size, and overall, I'm fairly happy with where my investments are at today. But more importantly, my time in the investing world from the end of 2019 to now has taught me a lot of lessons. I've made some mistakes, but I've also made some smart decisions, and both are very important from a learning perspective. In this video, I want to share some of those learning experiences with you. I have a mixture of both experienced investors and investor newcomers watching the channel, but shared experiences are equally as important to both groups. One of the main reasons why I started this channel in the first place was to help normalize conversations around personal finance, to get people to open up more when it came to conversations around money. None of us are perfect, and we all have room for improvement. So I hope that some of these points help you on your journey to financial independence. Number 1, have a plan and set goals. For the first 3 to 4 months of my time in the stock market, my investing activity was totally sporadic. There was no rationale behind what I was buying and when I was buying it. Some weeks I'd invest on 2 or 3 separate occasions, and oftentimes in the same investment, which is highly inefficient from a transaction fee perspective. I knew that my money was better off invested, as opposed to sitting idle in a bank account gathering dust, but I hadn't figured out what was the right way to invest. I was also investing very small sums of money at the beginning, which looking back came down to apprehension and lack of confidence. In hindsight, the reason why I was all over the place is because I never set out a plan for how I would invest my money. I didn't have a plan for how much money I'd invest, how often I'd invest it, or what I'd invest in. Instead, I was constantly topping up my brokerage account by nonsensical amounts and buying sporadically. Nowadays, I invest about once a month, where I transfer money from my bank account to my investment account and allocate that money across my bedrock investments. My bedrock investments are the investments which will be topped up each month without fail, irrespective of what's going on in the market. Check out the video popping up on screen now to learn more about those bedrock investments. But the reason why I now have a concrete plan which I stick to and I'm confident in is because I also have long-term goals. When I invest, I'm investing with a 30 to 40 year time horizon in mind. I don't have any specific number that I'm working towards over that period. All I know is that I want to invest as much as I can, as often as I can. In fact, I don't really believe in investing to hit a predetermined target. The reason why is because most people underestimate how much money they'll require in the future to sustain themselves. And so if you limit your investments to a number that isn't sufficient, you're hindering your potential. In the 2 years that I've been investing, I've only ever sold one investment. My investing strategy does not involve selling. I buy investments on a monthly basis with the expectation of holding them for 40 years, irrespective of what happens in the short term. That brings us nicely onto number 2, expect the unexpected. It wasn't long after I first started investing that the pandemic arrived and the markets took a major downturn. That was the first time of many during 2020 where my portfolio saw red in a big way. But because I had my plan and my goals, I was able to hold strong, even when things were at their worst. The lesson here is very simple. Nobody knows where the stock market is going to go today, tomorrow, next week, or next year. But here's the thing you need to understand. If you want to be an investor, then you don't care about the short term. Anything that happens today is nothing but a blip on a 40-year stock chart. If you're investing in low-cost ETFs which track an index, where's the sense in worrying about short-term movements? What's the bigger picture here? The bigger picture is that you're making investments for your future self over a very long investment horizon, so you don't need to worry about what's in the news today. But if your investments aren't backed up by solid rationale, and if you don't understand why you're doing what you're doing, then it's going to be very hard to stay confident in the short term. So what do you need to do to understand why you're doing what you're doing? Well, that's number 3. Invest in your education. Now look, no one is saying that you need a degree in finance to understand how the stock market works. In fact, a lot of the time, investors who totally rely on their formal education to make investment decisions get burnt, because as I mentioned, nobody knows where the stock market is going to go in the short term, and no degree is going to help that problem. Technical understanding of the stock market is important, but what's even more important is emotional intelligence. In the preface to Benjamin Graham's The Intelligent Investor, Warren Buffett wrote the following: "To invest successfully, what's needed is a sound intellectual framework for making decisions, and the ability to keep emotions from corroding that framework." This is why I mentioned earlier that you must have solid rationale behind your investment decisions, because if you don't, emotions will start taking hold. Let's say the objective for your investing activities is to invest for the future and to protect the purchasing power of your cash. You then decide to invest a sum of money each month, which gradually increases in size, into an S&P 500 ETF. This decision has solid investment rationale, because you know that over the long term, passive investment strategies beat out active investment strategies. And because you're investing for the future, you've a long enough investing runway to realize those returns. 3 ways to educate yourself: learn by doing, read from reliable sources, and challenge your understanding. One thing to be aware of is online communities. The opinions of other people, especially those who aren't credible, is just noise. If you're going to make a financial decision based on someone's opinion on the internet, at least make sure that they come from a formally educated background and or have a significant amount of practical experience in the financial space. I'm not saying that those are prerequisites to be a successful investor. It's just very hard to vet sources on the internet when they don't have any concrete background supporting their credibility. Just be aware that sometimes online investing communities can do more harm than good, because they oftentimes don't give merit to one of the principal goals of investing, which is to achieve adequate, not exceptional investment returns. That brings us nicely onto our 4th and final learning point: manage expectations. You are your own worst enemy when it comes to investing, and a lot of the time what you don't do is more important than what you do. By keeping your expectations in check, it will be much easier for you to weather the red days and keep the bigger picture in mind. The minimum goal of any investor should be to A, protect the value of his or her initial investment insofar as possible, and B, earn a return that at least outpaces the rate of inflation. Always remember the alternative to investing, which is keeping cash on deposit in a bank account gathering dust. So why is it that when you transfer money into your investment account, you all of a sudden start expecting the world when it comes to returns? I'm not saying that you shouldn't try and maximize your returns. In fact, it's quite the opposite. I'm saying you should try and maximize your returns, but in a way that makes sense in the context of your investment goals and overall plan. Don't bet the farm on one single stock, one single crypto, or one single anything. What would be the rationale for doing so if you expect to be in the game for 40 years? The fruits of your labor will come, but they won't come overnight. Take that point to be true, accept it, and build it into your investment expectations. So I hope that you found some value in those learning points. As with anything in life, the investing journey is one with ups and downs. That much is certain. But it's how we learn from those ups and downs which shapes us as an investor and helps build resilience. To summarize the points made, have a plan and set goals, expect the unexpected, invest in your education, and manage expectations. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.